My name is Max Scagliardi, and I'm here with co-host David Heikkinen, and we're live this week for Talk.Energy Insights. This episode's guest is Ashley Zumwalt-Forbes, and she's the president and co-founder of Black Mountain Metals. Ashley was also the very first episode of the Talk.Energy podcast, so I'm really excited to have her back on the show. And Ashley, thank you for coming on.
Great to be here.
No, thanks for coming on. Definitely, it's been a good week, good meeting you, and got a lot of good things that we can talk about as we're trying to branch more broadly beyond just the legacy oil and gas side. We've talked about transition, and I think you all are doing some really interesting thing on the metal supply chain and on the carbon capture side. So we've got a lot of stuff we can cover. And this will be live recorded, and we might get a few questions from the audience as we roll through. As we start each week, we kind of just peg this since it's immortalized online as far as where our perspective is for the markets and kind of what's happening over the last week. And so really essentially the S&P 500 is sitting right below all-time highs at 43.67. NASDAQ is up 4% almost over the last week, and WTI essentially is flat, even though it doesn't feel like that at $72. We dropped below 70 to 67 and rallied back up in the last week. Natural gas is up 10%, almost 11% at $4. And so we've got this golden age of energy where you have high commodity prices and low services costs, is something we've talked about in the past. And then we hit crypto and crypto mining. Max actually has a nascent business around that. So we summarized Bitcoin is holding in up 3% at 32,400. And then we do hit the metals. And so copper is flat at 435. And that's a perfect segue into what you all do in really the supply chain for metals as we think about the energy transition. So it'd be cool if you could just introduce yourself and kind of your business, and we'll hit into. We can just kind of free form from there. But thank you for coming on.
Absolutely. No, very happy to be here, and happy to kind of be the voice of mining for the Energy Transition podcast, which is really exciting. So exactly as you touched on, about 3.5 years ago, made a pretty hard transition from upstream oil and gas to battery metals mining, and also from the US to Australia. I think that's very representative of the supply bases of those groupings of commodities, which I'm sure we'll touch on. David mentioned the copper price. Copper is a big focus of ours, as is nickel, specifically class 1 nickel sulfide, as well as cobalt to a degree. No surprise, but a saying I always like to mention is, if you can't grow it, you need to mine it. And so when you're going through the energy transition, it's not like these things sprout out of thin air, like fairy dust is not a thing. And so inevitably, as we're going through the energy transition, we need a lot more metals in order to fuel that revolution. Again, I've said copper, nickel, cobalt, those are our main focuses at Black Mountain Metals. That's not it. There are actually a substantial suite of metals that the demand is substantially more in the future than it is now. So excited to talk through that.
Cool. How's that? Just real quick, since the last time we talked, it's been about 8 months or so. Just anything, I know it's gone by quick. Has anything just in the market in general, how's that affecting your business? I follow it just kind of tangentially through some of the stuff that we do, but just an update on from kind of then to today. What are some of the themes you're seeing? Obviously it looks like strong demand, as you just mentioned, but just kind of talk about how things have been impacting your business.
Look, again, we started Black Mountain Metals pretty dead on 3.5 years ago. We were early movers in the space. At the time, Tesla was like the most shorted stock in history, and EVs were a little bit of a blip. People didn't know if they were going to happen or not. 2020 was kind of the year of reckoning for broadly ESG, but particularly environment and acceleration of electric vehicles. I think, Max, since we last talked, really the difference is the acceleration is very palpable. I think the transition from the Trump to the Biden administration has really shown how much capital the government is going to put forth into the energy transition, and really where the kind of winners and losers will be across that thematic. I think we're seeing a lot more plans for incorporating this acceleration, whether it's through the infrastructure plan that's currently being debated, whether it's through the proposed increase in 45Q. And it's not just a US story. I think with the transition to the Biden administration, of course, this has been accelerated in the US. Europe has proposed a carbon tax at its border. Globally, we're really starting to see that capital allocators really care about this. And not only do they care, but they're deploying real capital to making this transition happen. And very much metals are kind of in the driver's seat here. So yeah, just further reinforcing the thematic.
Yeah, one thing as we go live, Max's video's off, but we can still hear you. But
can you guys hear me? I don't know what's going on with the video. I was messing with the settings. How's the mic level sound? Someone said they couldn't hear my mic.
I think it's fine. You're a little quieter than Ashley is and I am, I think.
What about now? Does that help at all? No?
Yeah, you're a little marginally, but
all right, we'll just keep going. I can see you guys. I can hear everything fine. I don't know why my camera's turned off, but
I talk very loud, so you never have to worry about hearing me. I've never been accused of being a wallflower. So
one of the things, just in context, that you might be able to help listeners and understand, like, can you talk about the total addressable market size, like the amount of capital that, we've talked about the order of magnitude of capital in the oil and gas spaces. Potentially a fourth or a fifth of the amount of capital that's going to be put into the energy transition as we get Max back live and can see what he was doing. But do you have an idea of like total amount of capital that needs to be deployed into the metals subsegment, or how much is deployed annually, and then the size of your business?
Yeah, look, for in terms of how much capital is the energy transition going to require, the answer is like, how long is a piece of string? Exactly how the energy transition plays out is yet to be determined. I'm thrilled that people are realizing that energy transition is not one size fits all. It's not like there's some silver bullet that's coming that like, oh, X technology, like we are saved. Like, let's all just get on that bandwagon. It's not going to happen. So every use case requires a very different solution, a different approach. Different geographies will inevitably take different solutions on board as well, based on what their local skill sets, what their local commodity profiles are. And so, look, the headline is it's going to take trillions of dollars of capital allocation to realize the energy transition. Exactly how that's allocated and exactly the direction that goes is genuinely anyone's. In terms of size of Black Mountain Metals, we raised and deployed about $100 million. So, we're not by any stretch of the imagination a huge player within the metal space, but it has been a really interesting exposure point to these markets and certainly looking to expand.
And that actually is something that you've hit before on the metals space. It really is a public markets segment. It's really Canada, Australia, a little bit of London, but really it as opposed to the oil and gas space, where a lot of the early capital is going to be more private equity and public equities. And then the energy transition is kind of venture capital, and now the SPAC market. Can you talk a little bit about the layout of the public markets in and around metals? And it's just helpful to understand how and what things have happened in your history.
Absolutely. So the kind of division across the metal space is quite different to how oil and gas companies are capitalized. So think of the mining market as effectively a barbell. So on one side, you have like some of the world's biggest companies, the major mining companies, BHP, Rio, et cetera, et cetera. The other side, you have some very small cap, kind of like penny stocks on the ASX or the TSXV. And what was a very big surprise to me was very small companies to get seed funding, instead of maybe doing a private round or going to private equity like you would in oil and gas. You IPO or you take a shell company on the TSXV or ASX. And so there are an enormous amount of public mining companies, but it's very barbell-like. There are some folks in the middle. There are some mid caps, but they're much more limited than what you'd see on either side. I'd also say, the other kind of two groups here would be like private equity and then trading houses, both of whom do own assets and operate. Private equity, not a ton of it in the mining space, like not at all. Private capital does not play very much within the mining space. I know everybody kind of got burned in the last financial crisis. And so people are being very cautious around re-entering the mining market, which I always think is pertinent, but certainly there are ways around risking or hedging your risks. The other group being trading houses. So Glencore, Trafi, et cetera, major players in mining markets.
Seems like with just the amount of, like you said, the momentum that's going on right now and the push for the new supply to come online, it just seems like there's got to be more capital flows into the space. And, we're seeing some things kind of from the Biden administration looking at domestic here in the U.S. Opportunities to mine. Last time we talked, you'd said it was very, very difficult, almost just not financially viable to permit and start new mining operations here. What's changed on that front? And then we'll kind of transition from that. What, if anything, has changed here domestically around either the narrative or anything that's actually happening policy-wise? And then we'll transition into just kind of the implications around the supply chain and how that's going to impact the way that this market evolves.
Yep. So on your first comment, it feels like there needs to be more capital flowing into the space. You're right. There does need to be more capital. And so often funds will kind of say, we were ESG investment houses, which is awesome. But they'll generally want to deploy capital into downstream uses. So battery manufacturing, EV manufacturing, but they'll take a view that they're not going to go further up the supply chain to mining because mining is considered dirty. I think that thinking is flawed in that if you're investing in the downstream use cases, you're indirectly investing in the mining business without the ability to influence outcomes. And so I think the way funds should approach it is adding mining, specifically battery metals mining or electrification mining, to their investment mandates, and then influencing the outcomes at these mine sites such that you're actually moving the needle on energy transition. We're starting to see it. Like, people are getting there, and I think that's fantastic. These things don't change overnight, but we need more capital if this is ever going to transition. On the second chunk of your question around how things have changed in the U.S., look, it's very hard to permit a mine in the U.S. And very much we have a NIMBY mindset, not in my backyard. So again, it's the very same approach that oftentimes funds take, that we'll do the downstream. We'll do the battery manufacturing, we'll manufacture EVs, but mining's dirty. I would challenge that. I would challenge that every day because people in the mining space are actually doing fantastic work around how to have a very clean mine site, how to electrify operations, like really how to be pertinent operators. What we don't want to do is outsource all of this production because, again, you have no influence over how it's mined. So you're not getting a good environmental outcome if you're mining from a jurisdiction that does not have strong controls. And second to that, you actually have no security of supply because the U.S., look, first of all, we don't have a tremendous amount of metal deposits that could be permitted. Not a very active mining jurisdiction. But it is, a bit of a different thought process. Something the U.S. has done. Can't always be just negative. I would love to be able to mine more in the U.S., but here we are. One of the positive things is the U.S. has formed kind of a critical minerals alliance with Canada and Australia, both of which very friendly economies, very resource-rich countries. So both Canada and Australia, I'd consider, and not just me, the world would consider kind of top tier mining jurisdictions. And certainly that's how we've spent our time at Black Mountain Metals as well.
No, it's totally interesting and analogous. We did a big report on global oil supply using some of the BP data and some World Bank data. And the US, Canada, Norway, Saudi Arabia are some of the cleanest producers of oil and natural gas and energy as a whole. But the policy in 3 of the 4 of those countries are to minimize the amount of production we have. And as an example, if you outsourced all of the US to the rest of the world, you're going to increase volumes from places like Iran and Russia and Venezuela that, you're seeing improvements in some of those areas, but they're still way dirtier and have much higher CO2 and methane emissions than the US does. And it would be a 3-fold increase in carbon emissions, if the US outsourced. It's a worse decision. I've used this analogy of a few good men, and y'all are younger than me, but it's you want us on that wall and you need us on that wall, essentially. And I think bigger companies and environmentally aware investors should be thinking about where that supply chain comes from and what you want to encourage as far as capital deployment, because the first step is a reduction in carbon, and then the final step is a complete elimination, and to get to the goals. And there's been some real progress in the developed world in particular around that, and that is an energy transition that's happening. And I loved your comment that every country is blessed with their own attributes as well, that it's you're echoing exactly our thinking, and I think it's the way that policy should be established. And hopefully with things like this, we can help people come back and ask questions about, well, what are our recommendations and how do we think about things? Because it is an evolution, and revolutions will happen as well.
Look, and I think the more people and markets, and particularly end users, realize that a commodity is not a commodity is not a commodity. All things are not actually created equal. Just because you're buying a barrel of oil or a ton of copper or whatever you're buying, the carbon footprint and kind of the pollutant footprint of those various units of commodities completely different depending on where you're sourcing it from. So what we're starting to see in the metal supply chain, which I think is super interesting, and I think it carries over to oil and gas, but end users or OEMs, for example, are starting to reach very far up the supply chain and source directly from specific mine sites. So just this week, we saw Tesla do a deal with BHP in Western Australia to buy nickel from their operation. So they're specifically honing in on exactly the mines the nickel is coming from.
Yep.
So they can put their hand on their heart and say, we know where this came from. It was mined in a responsible, both ethically, socially, and environmentally. I think second to that, if you look at kind of how oil and gas has evolved, particularly around what folks are calling carbon neutral or net zero LNG cargoes or even crude cargoes, with end users like Japan, South Korea, the big Asian economies that are big consumers but have large net zero goals, you're starting to see specific shipments earmarked for their carbon profile as well. And I think that's the future.
I think that, go ahead, Max.
I was just going to say real quick, how do you track, are you able to, when you can source mining, you're saying Tesla did a deal with BHP, and I know from the gas side, we think about this a lot, and in oil as well, around when you're producing a product, can you really trace those molecules? It gets really difficult when you get into that kind of these commingled situations in oil and gas. It's well, are these really my molecules that are making it from this basin to this pipeline to the Gulf to this LNG to this end user? Is it feasible? Some people will argue there's no way to trace those molecules and it's kind of just a paper thing. Is it possible in the mining space to really be able to physically track and know exactly where this is coming from? I'm assuming it is, but it's interesting to me because I think in oil and gas, it can get a little difficult when you get into the commingled situations.
For sure. Look, so on the oil and gas side, like commingling is a thing, particularly in a place like the US where we have such robust infrastructure. That being said, it doesn't actually matter, like from a let's take nat gas in the US, for example. It doesn't actually matter if it's that exact molecule or not. I think what matters is like there's a pool of carbon, and that pool of carbon is allocated to a specific volume of gas. Like, is it a perfect system? No. Conversely, nat gas in Australia, for example, there's not commingling, like not a thing. So they, really? World's largest exporter of LNG, but it's much more localized, right? So, for example, in Western Australia, there's like a massive LNG facility called Northwest Shelf. I actually think it was the world's first LNG facility, but maybe don't hold me to that. But it's a massive JV of 6 JV partners. They effectively, all of the JV owners own the surrounding fields, and it flows to the Northwest Shelf, and then they sell LNG cargoes from that. So look, there's commingling, but it's all coming through one LNG facility, and you know exactly where it's coming from. So it's not like it's being routed around the country. It is being routed directly to the LNG train and then sold. And so that's how people are able to do these like net zero cargoes or carbon neutral cargoes. And you're seeing it out of Australia quite a lot because you're selling to those Asian economies.
Yeah.
On the metal side, it's a lot easier to track. Look, it's still not a perfect science because like there are a lot of steps in the value chain. And if you're, look, it's much easier because it's like a physical product. You're not like sending it through a pipeline.
Sure.
You got to kind of like carry it around and trace it. So it's much more straightforward.
Well, I think that some of that is people don't understand that all nickel isn't the same. We can talk some about your sourcing of nickel sulfide and like that distinguishing all lithium isn't the same. And like it is, there are much cleaner options and much better options. And then there's a quality issue as far as what you're actually putting into a battery or into a system. That all rock and all metals aren't created equal. But it's kind of a segue of like y'all, when I was doing research on y'all finding, the mines and care and maintenance and being able to buy them, and then but also being nickel sulfide, makes a big difference as far as the process used. So maybe you can orient people a little bit around how you found the assets, kind of what your development plans are, but they're really just the distinguishing around the quality and process of the midstream of refining essentially that metal.
Yeah. So something I get all the time that makes me just want to like pull my hair out is and I'm sure y'all have seen this, like you've definitely seen it because I see it all the time. And I just, there's this like one photo of some rare earths processing facility in China. And it's like sludge falling into some like sludge. I mean, it's horrible. It looks horrible. And people are like, why are we moving from oil and gas? Like, this is what we're moving to. It is the nastiest mine site I've ever seen.
We're in the oil and gas. We've been in the oil and gas industry. We know what it's like to have like a single photo represent like entire processes.
100%. Like, look, I straddle both sides. Like, I was a drilling engineer. I rotated to drilling rigs all over the world. But it's frustrating. Like it's frustrating on both sides. Like don't just take one stupid photo and say this represents an entire sector. And so I get a lot of questions around exactly that. Like, oh, look, it's a nasty processing scenario and it's all rare earths. Like we're just bunching it into this weird grouping and just damning the entire energy transition. not the right approach. So we can walk through kind of the broad set of metals and why the different ones are appropriate, and then how we've kind of approached like a more environmentally friendly angle and kind of honed down on specific segments. So there are, we'll start with nickel because that's my personal favorite, but nickel, there are several different types of nickel. There's in batteries. So like class 2, you just kind of throw out the window if you're trying to be a battery manufacturer, right? Within class 1, there's sulfide and laterite. So we mine sulfide. Laterite is a more emissions intensive, more processing intensive material. So from like an elemental standpoint, it's coupled with iron, and you're required to use sledgehammer chemistry and something called HPAL, high pressure acid leach, to get the nickel out of that bond. It's hard work. It's both hard work and quite emissions intensive, also really expensive. So it's generally top of the cost curve. There's one nickel laterite deposit that's actually worked really well. It's owned by Sherritt and it's in Cuba. So like US investors kind of out of luck, but it is kind of the one shining star of the HPAL space. The others have been a graveyard for companies. So a lot of companies have blown themselves up on nickel laterite projects. So we're nickel sulfide, lower on the cost curve, much more environmentally friendly. It's literally grinding and flotation, no like weird, high pressure acid leaching. And so, huge differentiation in there. So if you just took a nickel laterite emissions profile or polluting profile and said, this is all nickel, like we should not use nickel, we shouldn't go to EVs, you would be wrong. It is more nuanced than that, as is oil and gas. Like not everything is created equal in here, and there are more responsible operators. There are better deposits. Maybe for nat gas, there's a dry nat gas reservoir that has incredibly low in situ CO2. So you're starting from an advantaged position already. Okay, so we'll transition. We'll transition to the lithium space. Something I get a lot in the lithium space is lithium brines in the lithium triangle in South America. Very water intensive, like very, very water intensive, and they're in the middle of a desert. So it's tough. Like it's pretty tough from an environmental standpoint. And it's something that Europe has kind of taken a stand against the lithium brines. That's not the only source of lithium. Like lithium is one of the most prevalent minerals in the Earth's crust. In Western Australia, they have deposits like hard rock lithium. They're called spodumene deposits. And they don't require that really water intensive, land intensive processing strategy. If you look at something like rare earths, so we have a rare earths deposit. Well, we have a few rare earths. The thing about rare earths is they're not actually that rare. The challenge is the processing side. So no two rare earth deposits are created exactly alike. Like rare earths, it's actually like quite a broad range of rare earth elements. They're like the low end and the high end. The operating one here is called Mountain Pass. It was actually bought by a SPAC, MP Materials, crushed it. Great SPAC. But Mountain Pass is a miner here in the US, but importantly, they don't actually process the rare earths here. So something upwards of 90% of rare earths are processed in China, and it's because it is a nasty process to process rare earths. And there's not really a great way around that. It's radioactive material. Instead of cleaner economies kind of taking hold of that and saying, this is an opportunity for us. We clearly need rare earths, so we need to figure out how to do this better. We have outsourced it to a jurisdiction that just has no controls around environmental policy. And we've effectively washed our hands of it and said, it's not in my backyard. I'm going to use the end product, so I don't care. And And I think we will start to see some movement there.
No, it's definitely this outsourcing of and not in my backyard is one of the things we talk a lot about. Is like it's human nature for people to want a better life for themselves and their children. And right now you have, I think it's 3 billion people that are suffering from indoor air quality problems because they don't have access to clean fuels, and 1 billion people have no access to reliable electricity. And access to energy correlates directly with human prosperity and GDP. And unfortunately, like we've got a lot of the world that is in energy poverty. And to a guiding principle of our firm and Pickering Energy Partners is really to help investors and really make investments in things that start improving that. But the thing that's striking to us is that the upstream in mining is similar to the production of oil and gas. The midstream is really those processes of who does it effectively. And really China owns the midstream business. And there's like some nickel laterite mines that are in Indonesia that are making some progress on emissions and quality. But that supply chain of the energy transition, whether or not it's solar panels, being manufactured by Uyghurs, and the outsourcing of solar from Germany, effectively Southeast Asia, that happened in the early 2010s and the teens, got to figure out a way to do some of this work and create those jobs really in places that are cleaner, like the US, Canada. Norway's done a lot on the transition. Saudi Arabia's moving hard into blue and green hydrogen. And the reality is there are cleaner economies, and we just need to recognize that. So I love that you said that, and I just wanted to echo it and repeat it for all our audience to hear.
Look, the beauty and the curse of resources is that like they are where they are, right? I mean, it kind of goes back to like, if I could just pick everything up and like move it to a really easy and environmentally friendly place to operate, be 10 out of 10, that would be incredible. You can't. So like that is why it's not a one size fits all approach. Like everybody's going to have a little bit of a different spin on it. Ultimately, I think that's likely why it's going to take more overall capital to realize a transition as well, because there's not going to be kind of a coordinated silver bullet. But we need to find ways of also kind of bringing people up to tier 1 jurisdiction standards, because just because we're not entering these jurisdictions, example, Black Mountain Metals, we're probably not going to mine in the Congo, right? It's not in my skill set to go buy a mine in the Congo and try to ensure that we're mining things responsibly, that children aren't in the workforce, like that. We're mining in Australia, right? But just because we're not investing in the Congo doesn't mean no one is investing in the Congo. Like people are investing there and they are operating. And if they're not companies that have strong ESG controls, you can assure yourself that things are not being done the proper way. So we can't just turn a blind eye and say like, let markets kind of sort it out. There is an awesome company, RSC Global, RCS. Look, one of them, RSC or RCS. I get it wrong every time, so it's one of the two. They specifically focus on this exact thing. So their South African company actually started to keep blood diamonds out of the market, but enable those jurisdictions to mine diamonds ethically, but effectively certify where things were being done correctly and where things were not, so that they couldn't get into the market. They saw the parallel opportunity with cobalt in the Congo, because you want these people to have a better life. Like who am I to say, sitting in my house in Fort Worth, that people in the Congo can't mine cobalt? Like they want a better life for themselves. They want jobs, and I want that for them. And what RSC does is they go in and they certify the mines. They help workers ensure they have proper PPE, ensure they're doing things in safe ways, and ensure that the products getting into the market are legitimate. And I think we'll start to see more of that.
I was just going to say that these types of conversations are the reason why I wanted to have the podcast. I mean, I think it's so nuanced in the energy industry. It's just so complex. And I think that these conversations are actually really important, because if you think about some of the policy things and some of the things, not just even just policy, but just like public opinion of things, like, right, like people want to shut down a pipeline, or they want to stop drilling or fracking somewhere. You have to peel back the layers of the onion to look at what is really decarbonization, what is just carbon offshoring. And that was one of the bullet points. We've hit on a bunch of them in some prior episodes even as well. But it's like, look, if you're cleaner and better at doing something like we are in the U.S., and I picked on California before, they've got some of the cleanest oil fields in the world, right? I mean, if you go there, they're just incredible, pristine. And then you look at them shutting it down. Basically, they want to completely shut it down and then outsource it from countries that don't have E, S, or G. And so it's just, I think that most people don't have access to conversations like this. They just don't. They don't get to hear the nuanced topics. They don't get to hear about the different layers of the decisions and what happens. And so I think that these, like, again, I just think this is incredibly important. And to me, it's fascinating to understand these different things and like what the real impact is going to be. And that's always been my thing all along, is that like, I'm always trying to get down to what are the goals, what are the impacts that are actually going to have. And then when we have the talking points and the narratives, what decisions and behaviors are those driving? So this is good stuff.
People get caught up in the noise of endpoints and deadlines of 2030, 2050, and the reality of what we want people to talk about. And there is rightful skepticism around those aggressive transition scenarios, but it's the trends that actually matter. And like, the trends are actually that fossil fuel based energy sector is improving, and probably isn't going to be completely eliminated, but it is getting better. And there are places that are doing that. And there are parts of the world like Denmark and the US that have improved energy efficiency or blessed wind, but power and transportation sectors aren't going away. And that's what we tend to think about as like, if I could say one thing to everyone, both from a political and like, stay focused on the trends, not the endpoints, because we can argue endpoints like that. It's hard to say, is it 2030 or 2035? And, are you going to be all EV by 2030? You're going to have, 130 million around the world on the road. Like that is unarguable and not worth the time. Like, it is really what's the trend and what can actually be accomplished. And I think that's what you guys have done interestingly at Black Mountain. Like, we didn't even hit on it yet, but like your carbon capture thoughts, and like you were early into nickel and some of those trends. It's really where those opportunities created by the energy transition, and y'all seem to be trying to capitalize on them.
We're trying.
So a plug for y'all.
Thanks. One thing I do want to touch on before we can talk about carbon capture and stuff too. Love
some
that
other
market.
Time. Yeah.
I think it's like the trade of the century. I like genuinely believe it. But in fact, let's not digress. On your prior point, what I think is actually like particularly important for people to understand, you can't like snap your fingers and the transition happens. And it's like super easy to put stuff in a spreadsheet for like bankers or whoever to put stuff in a spreadsheet and say like, this happens in this year and this happens here. Look, I think we need to approach this from like an operational, like practical mindset and say like, how long does it take to permit these things, to build these things, to capitalize these things? It's no small feat. Like, it is an enormous transition. And in no way am I a naysayer. So I don't want people to think like, oh, Ashley's like hating on the energy transition. I'm not. I'm a believer. I've like proven that. That being said, I'm just a very like pragmatic person. And so because, part of society believes that energy transition can happen instantaneously. And like, I'm thrilled that they're so optimistic. I would love to be that optimistic in anything in my life. But, part of society believes that, and so is taking actions to shut down the carbon emitting sectors prematurely. So we're effectively decapitalizing those sectors before demand goes away. And all we're going to do is drive prices up. and effectively damage the energy transition. So I think like methodical, purposeful decisions along when these transitions happen and making sure we are properly set up to do it. We need those controls in place. We need to follow proper process or this thing's going to go off the rails.
Yeah, it's this simple statistic that I tell people. So there's 7.7 billion people in the world, and Europe and the US and the OECD are 1.4 of that. And our population hasn't grown for the last 10 years, maybe 50 million people. In the world population is up about 1 billion people on the remaining 6.5. So as you think about the energy transition of the next 25 years, the people with the least access to energy today is where population growth is happening. And unless there's a way to figure out how to enable them to take advantage of what they have, like your comment on the people in the Congo, like we can influence where capital comes from and how it's deployed, but those people are going to want to see economic improvement and development. And you can't have energy poverty, and you'll source from what you have. And that's really the order of magnitude of what happens during the next 25 years of the transition is real population growth, and no one's advocating population control. Like that's just crazy talk. And so like everybody knows that like the world's going to continue to develop, and we have that influence and that ability to not broad brush things. And I think what you all are talking about with your investments in Australia, that makes a ton of sense. You know, the re-engaging of, you know, nickel mines that weren't running and trying to do it effectively and cleanly, you know, that, and then the biggest companies that are out there are doing it better as well, hopefully. So just measuring and understanding that is important. So I know, Max, you had a couple other things on our agenda. We're 40 minutes in, so I didn't know if you wanted to transition to something else, but I know we kind of broadly brush things.
Yeah, this has been one of the main things. And I think we kind of talked about supply chain, and we talked about this decarbonization versus offshoring. And I'll get on my high horse for one more minute and talk about my industry, and natural gas is what I've always been focused on. But again, it's another one of these things where you can do it in a way to where it is, in theory, especially on the power gen side, you can sequester those emissions if you want to, and that you can incentivize people to do that. And so that's an incentive for people there. We can transport it across the ocean. So for these places that are in energy poverty, you can invest in LNG terminals, and because if not, maybe they're gonna gravitate towards coal. By the way, the byproducts for natural gas are crucial, right? So we use all these products, these plastics and synthetics and rubber and all these things, and we're gonna need those forever. So there's real practical ways to think about. And again, I'm talking my book. I always try to be careful with when I talk about the energy transition, because one thing that really annoys me is when people like say all this stuff about how we got to switch to one thing, and then I find out they're selling that thing, and I'm like, yeah. So I always caveat it with I am in the vested interest of natural gas, but there's ways to do it better. Anyway.
Look, I'm selling nickel, so y'all know I'm preaching my own book, but
yeah. Well, that's good. No, but you're doing it in a way that's honest and upfront and transparent, and talking about the nuanced aspects of why it can be beneficial. And I think that's critical. Again, it's the conversations that need to be had. You got to get away from the rhetoric and get away from the talking points, and get more down into the details around how these things are going to work, and what are we going to do about those people that need to have that energy, and how are we going to transition this thing. And Heikkinen and I like to talk a lot about, and he's made some awesome points around just efficiency in general. Like efficiency can go so far towards a lot of this stuff. And if you really, people want to think about these wholesale changes, these big sweeping changes, but efficiencies along the value chain, things like looking at that supply chain and figuring that out, that can get us, I think, big leaps. You can take a lot of small steps to end up going a long way.
That's going to be interesting to watch, like whether or not it's the LED lights that we have or CAFE standards for cars, but the natural gas industry did a great job of branding itself and then lost the narrative. Natural being applied to gas, and everybody likes to cook with it. We're watching now the renewable methane business. Like they're rebranding natural gas to renewable methane, but we did in our. I think it's a great way to rebrand it. Like it, and you got a lot of companies that are thinking about ways to have cleaner natural gas. This was one thing that was interesting. Global flaring, so I'll bash the oil and gas industry, is 1% of total emissions. Unless it's an upset, there is no need to flare natural gas. We all know it. Like at Exxon, like minimization of flaring. Like Norway is a clean economy, produces a ton and doesn't really emit much carbon from the way they produce. And so on an order of magnitude, everybody talks about the hydrogen economy. So the current gray hydrogen economy is 3 times the size of the emissions. So it's 3% of emissions globally. Flaring is 1%. And so like if we want to really be a clean transition and fossil fuels are going to be part of it, like everybody that's an oil and gas folks on this call and watch these, like figure out ways to have closed systems in North America and then export those to the rest of the world and eliminate flaring other than on upset. And that is a huge opportunity. And it's 1% of global emissions. And so that's a third of the transition from hydrogen. Like you hear about trillions of dollars of hydrogen economy emerging, moving from gray to blue to green. The order of magnitude of flaring is something that we can fix today. And everybody that's on this can start thinking about that today as well. And there's companies, EOG has put it in their investor presentations. Like if you want to learn how to do it for free, they'll give you the technology. Like just call them up and like that. Anadarko did a lot of it. Oxy did a lot of it. So the independents in the U.S., I'm a huge advocate of what they do, but they also have their flaws, and they're moving down a path towards no flares. The other thing that is just getting on my high horse about flaring, because I was a facilities guy at Shell at one point, long time ago. Flares don't always ignite. And so the worst thing you can do is have a flare that doesn't light, and then you're just putting methane in, which is obviously way worse than CO2. And so there are a lot of things that we're thinking about on that efficiency side. And again, it's the trend of ways to improve. And we've got a big ESG team at Pickering Energy, and we want to have some influence over how the market thinks about our sector relative to everyone else. And they say this in meetings all the time, that Amazon's scope 1 and scope 2 emissions are the same as Chevron's. Almost, like it's a little bit better, but Amazon gets a much better environmental score just because of the sector they're in. It's a matter of time before the market actually starts seeing more broadly how E, S, and G actually fits beyond just our little vertical of the energy sector. And
absolutely.
As you think about your business, I did think in order of magnitude and just some specific questions. Do you have any thoughts of like where you fit on cost of supply? Like how should we think about the metals business on, is it a cost of supply? Is it a yield of like what you get? Like how does I'm ignorant. So this is a purely like educate me, and hopefully that'll scratch my own itch, and hopefully people on the call want to hear it too. But please.
It's not dissimilar to the oil and gas business. So the way we always reference it is like quartile of cost curve. So we always aim to be kind of second quartile in the cost curve, maybe even low third quartile. Usually those kind of like first quartile cost curve folks. I can take the nickel market, for example. Lowest cost curve, it's actually like negative cost of production, is Norilsk's assets in Russia. So they are predominantly platinum palladium mines, and they just like produce nickel. Doesn't matter. It literally doesn't matter what the nickel price is, like completely subsidized. And if you look at any cost curve, they show up negative. Look, a primary nickel mine, you're going to be pretty hard pressed to be in that first quartile. But we really do aim for that sweet spot, second quartile, low third. When you're starting to get higher up, those are usually your swing producers. Oftentimes, if you're looking through the lens of energy transition and where commodities are going from here, it's kind of arguable if those will actually continue to be swing producers or if they are very much in the base case. You never want to make an investment decision based on, that commodity is going to increase in the future. Like I'm going to crush it in the future. It's probably not super sound, right? Because you're using your crystal ball. Like you don't know where the world's going to go. You want a business that fundamentally works now. And if commodity price rises, awesome. That is upside. That being said, where metals prices are now is materially higher than when we started Black Mountain Metals. And I think you start to look at some of these fourth quartile operators and think like, not a huge stretch to think like, even if you bought those, you could make some decent cash.
Interesting. That's helpful.
Yeah, that is interesting. Well, this has been super. Every time I love the space that you're in. It's just interesting to me because it's outside of the outside of the scope of what I think about day to day, and it's also going to have a lot of impacts around the things that were, that are mainstream talking points and that people want to push towards these goals. And you're going to have the mining and the metal side is going to play a key role in it. I think to just kind of recap on some of the themes, it's going to be a center point of this transition. It's also going to be something from a supply chain standpoint that we have to focus on. We're not going to be able to get to do some of these things that people want to do. I think what's shown us this last year in COVID around supply chain constraints, I think supply chain should be under focus, not just for this, but for a lot of industries right now, and how when the world has issues or things that happen, it can impact economies, it can impact trends and themes and what businesses are trying to do. And certainly for this in our space, right now in the U.S., the oil and gas industry is uniquely American. We have a bunch of we're very good at it. We can do it very well. Into the transition, you look at this, and it's going to take a collective effort with allies and partners like Australia to be able to get some of these things done. Which is it's just a much bigger mosaic of problems that we have to, of a picture that's going to, emerge, and we have to solve all these things. And it's very complex, which is why I think David's always very interested in it, why I'm interested in it. And then lastly, the last theme to just kind of recap it and end it here is just what's actually effective. Are we decarbonizing? Are we doing the things that are the goals? Are we just offshoring and it's not in my backyard? And so this has been a great episode to hit on those themes. David, is there anything else you want to put in here before we end it? But that's kind of where I'll leave it. Ashley, it's been great. I'm glad that you came back on.
No, it was so fun, guys. I appreciate it.
That was a great recap. Thanks, Max. Thanks, Ash. We'll be in touch.
All right, guys. You have a great weekend. Appreciate it.
Yeah, happy Friday. Bye.
Bye.